In this chapter 12, the final chapter of our pre-Civil War era, we've been talking about for several chapters here the, in some sense, the infrastructure that was required to build the modern economy, to build the industrialized economy that we had in the United States. What you should be learning over the course of these few chapters is that it really took a sort of special combination um, to achieve the growth that we got. And the thing is that theoretically, we didn't know what all the elements were. So it's not like Alexander Hamilton at the turn of the 19th century, before he passes in 1803, could have said, if we have this, this, and this, then we can build this, like we can today. Right. So today I could create a new country, and we know enough today about how to build a modern economy that you could kind of lay out a game plan. In the United States, we were just lucky. And so we talked about in the previous chapters what these elements were and basically the ingredients for pulling this off, with those ingredients being that we needed plenty of land with the natural resources that could be extracted from it, that we needed the transportation infrastructure, that we needed a system that would allow for specialization of production, both manufactured goods on the East Coast and extractive goods, extractive natural resources on the frontier. And the final kind of element of this building story requires us to talk about the monetary system. And that's where we're at. Okay, so let's start talking about it. The one notion that we have here already is that the United States, in some sense, was unique. The unique nature in the United States is that we weren't the country to invent it, but we were among the first countries to use a paper currency. And in the early colonial period, each state was issuing their own currency. That was stopped by eventually this was stopped by the Constitution. But when we started out as a country, the Constitution gave the central government the ability to make its money. States, interestingly enough, stopped making the money, but what they did is they established banks, and those banks individually issued their own money. So you did have multiple currencies out there, not just from the United States, but from these sort of local economies and these local state-based banks. And what we see, at least with the kind of emergence in the United States, is that we also had to recognize the fact that, especially in the South, but we're exporting a lot of goods. One of the common international currencies at the time would have been the Spanish peso, which had the nickname of the dollar, hence what we get here. And although maybe especially in New England, they would have been using the British currency of the pound, and the shilling, the dollar pretty quickly became used more often, not only because of the role that the Spanish played in the exporting of the goods, not only because of the closeness of the Caribbean and the West Indies, which would have been a key international trading partner, but also because the English system, which relied on shillings and pounds, ended up the divisions required were much different than the very easy decimal-based system for the peso. The British wouldn't until 1976, I think, 1976 or 1977, they wouldn't drop the shilling pound division and adopt the decimal system until basically I was like 1 years old. Obviously, in the United States, here we rely on the decimalization-based dollar, right? 100 pennies equals a dollar, 10 dimes equals a dollar, 4 quarters equals a dollar, that kind of thing. Um, Thomas Jefferson, Alexander Hamilton, as well as Robert Morris. These were the three kind of individuals that believed most earnestly in this push for a currency that was decimal based. Now, the concern very early on, I mean, outside of the fact that you've got a central government that's then providing the currency, well, the big concern would be is that this new government with these new people is going to print too much money. And like, why would you want to trust um, this central government that is so far away? And they had seen, at least during the revolutionary period, um, they had seen a great deal of this inflation already because that was part of the way that they financed the system. So Jefferson and especially Hamilton would have known enough that um, they had to find the right kind of commodity-based system, meaning were they going to have a gold-based system or were they going to have a silver-based system? The issue would be is that the most the monies held in the highest respect internationally were gold based. But we were a new country, and you want to build an economy, you need a lot of money out there. So, you know, it was doubtful that we would have enough gold to kind of supply this kind of newly emerging economy. So instead, what you use is silver for just kind of greater um, what economists would call velocity, but basically higher used coins, lower denomination coins. So they would use silver for most everyday coins, gold for larger coins. And then what you would do is you would have paper money, which could be then used to kind of serve as being gold-based as well, where people could turn in those paper-based currencies and get the equivalent of gold. What we get at the end of the day is, courtesy of the Constitution, you get the Coinage Act of 1792. And what the Coinage Act of 1792 decided is that, again, we were going to have a gold-based and a silver-based currency, and that it was going to dictate how much gold and how much silver was in each denomination. I don't want to get into all that detail. We're not that, we don't need to be that special about it. But let me show you this. Thought I had it. I remember when I was at Notre Dame, they had a really, I mean, this is just kind of a nerdy thing, but they had a really interesting collection of coins in the library, donated by someone old, long ago, far away kind of thing. But they had a really interesting collection of these coins and whatnot. I'm not sure if they're going to show any big pictures here. Maybe. Oh, it just tells about the coins they have. It's not showing any pictures. I didn't see all these coins. Just okay. Well, they had a lot. Sorry, that was kind of pointless there. Okay. So anyway, it they adopted this bimetallic system from the 1792 Coinage Act. Pretty difficult to use though, because now what you need to do is you need to make sure that there's this principle within economics known as Gresham's law, which would say that um, overvalued coins would tend to um, be used more often than the undervalued coins. And so you could see that people would then hoard coins that were more valuable, not use them, and use the coins that were for some reason inaccurately overvalued. Or in some sense, bad money drives out good money. So you had to then make sure that the ratio of the gold to the silver within each coin was kept at a rate that denominations weren't worth more melted than they were being used. Pretty difficult to do. What we see, and there's a lot of interesting research about this. One of them by one of the authors of the book, Rockoff, Hugh Rockoff, again, one of the co-authors of the book, did a lot of research on this as well, just to kind of see how good did they keep these relative rates. What we see is that they didn't do a very good job. And that we did have from time to time either the gold coins or the silver coins being overvalued or undervalued. But despite that difficulty, the fact that we took on the decimal-based dollar ended up being a really good decision because it helped us, especially having it being both gold-based and silver-based, really helped us out in terms of the new currency being used internationally. And um, what the United States is trying to do is it's trying to grow as a country, is it wants its dollar to be used more often, and it wants to have control over the currency as opposed to, again, the Spanish peso or the British pound being used. Because then they, in some sense, get to control their destiny. And their destiny is being dictated by the fact that they still do have to export and import a great deal of goods. And so the faster we can get the dollar being used, the better the flow, the more stable the flow will be of the goods that are needed. The one thing we're seeing here, and I just want to make sure I'm not skipping over anything here, the biggest problem early on was the fact that while the federal government, while the central government was printing coins and issuing dollars, the states were also, again, forming these banks, and the banks were then issuing currencies based on um, based on their deposits. But the problem, as we get right here, is that that means that we don't have a uniform currency. We have some people using federally central government issued currencies, and then we have local currencies being used too. Now, we actually see this best in the book. I'm guessing this is Rockoff here. But anyway, this is from 1853, and this is basically just saying, like, right, if you're a merchant who's not in Louisiana, and some traveler or whatever is trying to pay you with Louisiana currency, you would have to kind of sort through. You'd have to use this kind of North American banknote detector and commercial reporter. You'd have to use this kind of reference book to kind of figure out, is what this person's giving me, is it worth what we think it's worth? And in a situation like that, I mean, look at this here. So we had, by 1811, we had 88 different banks, 86 of which would be state chartered banks that were all issuing their own paper money. So that would mean then you have 87 total different currencies out there. Way too crazy. And at least in the beginning, we don't have a central bank that's issuing the money. right? We don't have the national bank yet. And so, yeah, the issue would be is that you would be issuing, certainly if you weren't traveling and you were just doing transactions locally, yeah, people would take your Louisiana dollars if you were in Louisiana, because they're coming from the Bank of Louisiana and you're used to using those currencies. And you would take the national currency because you know what that looks like. But to take anything else, you're probably going to have to only accept it at a discount, meaning you're not going to accept it at 1-for-1. And that, in some sense, discourages transactions from occurring because now I don't think my money is worth as much as I think it is. And now, most notably, a dollar that's held as a Louisiana bank dollar is not the same as a dollar held as a Maryland bank dollar, et cetera, et cetera. And now what do we got here? Now we just have chaos. Now we have disorder. Now we have um, basically a currency that's um, a currency that has varying values. And the thing is that this problem becomes only worse in the decades leading up to the Civil War. I mean, look at this from the textbook. That's estimated that by 1860, more than 1,500 banks issuing on average 6 different denominations. That means you have 9,000 different types of notes being issued. 9,000 notes. Again, that's insanity. That you're not going to get a great deal of economic transactions occurring in that kind of environment. And obviously, too, the one thing it does encourage would be is it encourages counterfeiting because now you've got a situation, you've opened up a situation where you can take advantage of people not knowing everything that they need to know. And the pause here. So now, important in this discussion of the kind of the overall situation that we have for currency. So it's one where it's a little bit disordered in the sense that we have a system that relies on gold and silver to determine the value, and then you've got to determine the value of each of those compared to each other. But then you also have a situation again where each of the individual banks are issuing their own currencies. And again, you've got merchants that are willing to accept them. And then again, you've got a situation too where we don't have an incredibly clear banking system. And we talked about this in the previous chapters. And in the previous chapters, we talked about how there was a first Bank of the United States and then eventually a second Bank of the United States. Well, that's going to have part of the issue here with the currency being used. So when we talk about the fact that the US dollar was being used, it was 3 individuals. It was Thomas Jefferson, the Treasury of the Secretary, Alexander Hamilton, and Robert Morris. So Robert Morris was the one who was charged with creating the first Bank of the United States, our national bank. And he does this in 1781. So this would be before the Constitution was passed. Hamilton, who had been the Treasury Secretary, was the one that was pushing for the establishment of the national bank. And again, he wanted to do this because he wanted the bank to borrow money and build up the credit rating, for this new country. He wanted this first Bank of the United States to also be managing the money of the government, both something where the government could basically have a savings account, basically. But the idea was that the first bank of the United States, the central bank, wouldn't be run or owned by the government. Rather, the idea was that the government and the private sector would both run this bank and both own this bank, thus, in some sense, creating a stronger relationship between private industry and the public sector. Now, the government gives the initial money to start this Bank of the United States. But what this Bank of the United States is going to be doing is, it's going to take the deposits that it got originally from the government, and it's going to use that to start issuing the national currency, right? So the currencies are coming by virtue of a bank, and the bank that they're going to come from, at least in the beginning, is that first central bank that we have. Hamilton and Jefferson disagreed quite a bit on this bank. Jefferson would have been most opposed to it because he was from Virginia, and Jefferson wanted this, again, this yeoman farmer, individual farmers, is kind of like the bedrock of this new democracy. The idea of having a national bank, a central bank that's at a great distance from the people, struck at creating classes within the society. And so, as the third bullet point here says for the Jefferson opposition, he feared that it's going to benefit the wealthy elite at the expense of the ordinary people, that they would have just gotten rid of the British, and now they would have the moneyed interest as kind of running the economy. And again, the central bank could also then wreak havoc on Jefferson, who wanted this decentralized agrarian economy, whereas Hamilton wanted a central bank. And he wanted this central bank not only because of building the credit rating and whatnot and having the government have a place where they could kind of exchange funds, but he also wants to rapidly industrialize the country. And for rapid industrialization, you need a lot of credit, you need a lot of money, and you can only do that with a central bank. So the two differ. Again, Hamilton gets shot by Aaron Burr in, again, I think it's 1803, 1804. Jefferson goes on to be the president who engages in the Louisiana Purchase. The National Bank, once it's established, it exists. It's given a 20-year time period. It's a really cool article. Let me pause this. There's a really cool article. Give me a second. I knew I had it somewhere in my computer. It's 36 pages, but if anyone's really interested in this article, yes, I understand it's from 1942. It is really old, but it's such a cool article because what it does is, when you're going to build a central bank, what you want to have is you then want to distribute the branch offices throughout the United States. And so I think, if I remember correctly, if I scroll down enough, I thought there was a map here at some point. Oh, we definitely have one from the textbook, so let's just go to the textbook's map. I thought I remember the book having one. Maybe the book didn't even have it either. Sorry, give me one moment here. Yeah, so we have it in Boston, we have it in New York, unsurprisingly. And then what it does is and we've had some in the South. I'm just gonna I'm just going to look at the images here and look at the one really quick. No, I thought I'd find it much faster than seems to be happening here. Okay, here we go. Boston, New York, Charleston, Baltimore, Norfolk, Savannah, Washington, D.C., and New Orleans. What are you seeing here? You're seeing port cities of where this exists. Again, that highlights the importance of why you need this banking system for the export of goods. And that's what you see right here, right? That's going to do a great deal both in the South and the North. You distribute this bank so that you start to build up the export industry within this. Those who would be opposed to it, the anti-federalists, they thought that the North was going to value the most from this bank being established. They thought that there was nothing in the Constitution that granted Congress the power to establish this bank. And again, they worried about the people themselves losing some of their rights and liberties to the fact that this bank was going to control more things. And all of that together, once the bank gets established in 1791 with Washington, it has a 20-year charter, and as the AI overview gives us here, tells us that it does not get renewed. And so the bank dies, the first bank dies in 1811. The biggest champion of this, Alexander Hamilton, he was already dead. So, yeah. I mean, at this point, too, these branches, if you look here at footnote 3 on page 206 of the book, we get the idea that, again, that the Boston, New York, Baltimore, and Charleston branches were first in 1800. And then you add Washington, Savannah in 1802. And New Orleans after the death of Alexander Hamilton after that. Okay, let's go back to the slides. The first Bank of the United States, it did achieve its goals, despite the fact that it was that the charter was not renewed. It helped incredibly in stabilizing the currency, getting the currency accepted internationally, and expanded the overall credit rating of the United States. This bank also served as a lender of last resort. It helped the US government in paying off all the debt that it had accrued during the Revolutionary War. In 20 short years, the general idea of economists, the general conclusion of economists, is that this bank was wildly successful at achieving its goals of establishing a national currency and establishing a national banking system. But despite that fact, the charter was not renewed. But don't worry, we get a second one. And that would be the Second Bank of the United States. And that goes from 1816 to 1836. Why do we need it? Well, if you remember, 1811 is when the first central bank is not having its charter renewed, and then we get the War of 1812 with England. And think about it, we weren't that old yet, right? We were 20 some, not even 30 years old. So, and this was a pretty significant event, right? And this is actually fought in the United States to some extent, right? You've got the burning of the White House of Washington, D.C., by the British in the War of 1812. And with no central bank to control the currencies, the War of 1812, unlike the Revolutionary War, was financed primarily through inflation. So basically, the government just printed a bunch of cash. And that rapidly high inflation gave a bit more background and support to Congress to establish the second bank of the United States. So again, in establishing a bank, what you need is you need some money to start off with. So the second bank of the United States got $35 million. 20% of that came from the federal government, 80% of that came from individuals, firms, and states. And so this second bank of the United States was established in Philadelphia. I've been to it. It's actually a pretty cool office. It's actually not too far. Um, it's not too far from the University of Pennsylvania campus. I spent a summer in Philadelphia, and so my apartment wasn't too far away from the second bank of the U.S. Pretty cool. I'm probably the only one that thought it was cool, but I did. And just like before with the first Bank of the United States, there were branches that were established. But even the second bank, as successful as it was in regulating the currency and controlling inflation, Andrew Jackson, who was kind of like the um, um, kind of the Donald Trump equivalent in the 1830s, in the sense that Andrew Jackson liked to strike himself as a president of the people and against these very kind of rich, moneyed interest people. Andrew Jackson was against the Second Bank of the United States. The Second Bank of the United States was run by a person that Andrew Jackson didn't like at all, Nicholas Biddle. And Nicholas Biddle did do a really good job at managing the US dollar, at building the banking system up again, getting regulations passed. Andrew Jackson didn't like the guy nor his policies. And so, despite the good work that Biddle was doing, when Andrew Jackson wins his second term, he takes that as a sign from the people that we should get rid of the bank, as it was known. Andrew Jackson was from the frontier at the time. He was from Tennessee, and Jackson was very much against this kind of central banking system. And so, yeah, the bank died. Yeah, sorry, no, sorry, one correction there. It wasn't, I don't think it was Jackson's second term. I think actually when he was running for his first term in office, I think even back then he said he was against the central bank. So it would have been much earlier than 36. Let's see, 1828. So Jackson would have run for president for the first term in 1828, and I think he would have been against the bank as early as then. But again, since it was established in 1816 and had a 20-year life, I think he would have said in 1828, I don't want the bank to exist. And by 1836, he would then just let it die, which he did. And that's what we get right here, right? So the Congress did try several times to get the bank um, to be able to continue its charter, but Jackson would veto those efforts, and he continually did that. And as I said, Andrew Jackson was defining himself as this president of the people, of the commoners, and the bank was seen as elitist and moneyed. And so fighting against the establishment of the bank was kind of part of his personality. So instead, what happened, which is not good, is that in 1836, the Second Bank of the United States goes away, and then Jackson takes the money from the Second Bank of the United States and distributes it to banks located in states that are loyal to Jackson. This ends up being incredibly bad because then this means that the banks are loyal to the president. And that would mean then that they issue currency in ways that are serving the interests of Andrew Jackson and that they're making loans that are in the interest of Andrew Jackson. So we get a very politicized banking system emerging after the end of the Second Bank of the United States. And unfortunately, we get, after the end of the Second Bank, we get basically a banking war. Where basically banks compete with each other in the issuing of banknotes, in the regulations that they face. Basically, it's incredibly easy to issue a bank, and you don't have to have a lot of capital, and you're not regulated that extensively with your banking system. It's really bad. And you see this with this kind of bullet point here, is that after the Second Bank of the United States ends, we've got a lack of regulation, state chartered banks, and all of these, and then some of these banks are loyal to the president, not to their depositors or to any kind of sound accounting principles. That's bad. So here's what we got in the lead up to the Civil War. We've got a disorganized currency system with both a national currency and state local currencies. And you've got the beginnings of a national banking system, which then devolves into a decentralized state banking system. So you've got two bad sense. And that takes us actually all the way out through the Civil War. So you've got state banks with varying degrees of regulation, banks that can be created with very minimal oversight. And again, that these banks are making decisions that might support politicians more than they would having a sound financial system. So let's compare this, right? At this time, the same era, let's say mid 1830s to 1863, this would have been the same time that the states needed a lot of money because they were building the railroads, supporting the railroad system. You would have had the emergence of the Civil War, where the US government needs a lot of money to finance the war, and the Confederate South would also need that money too. And you don't have a currency system, nor do you have a banking system to support it. That's pretty bad, and that's a bad combination of the two. Yes, all of these problems I've already talked about, all of these policies, so I'm not going to just repeat it here. But again, we don't have a single currency. All the banknotes look different, and banks are failing with a bit more frequency. Okay, I'm going to pause here. So one of the things that we need to start to do is we need to start to create a system to organize all these various notes that you have going out there. And so one of the things that we try to do in the lead up to the Civil War is we create something called the Suffolk system. And so what this was designed to do is that the Suffolk Bank of Boston was going to stabilize the state banknotes. And what the system would do is that it would allow banknotes within the New England area, that these New England banks would all accept each other banknotes at par, meaning, $1 for $1. Um, and what that did is because each bank was accepting the other currencies at par, then all of the banks had to hold enough notes. They had to hold enough reserves. And that actually did a great deal, at least in the New England area, to stabilize the banking system and the currency system, despite having so many different currencies. This system, which started out with just 6 banks, um, it actually goes all the way until 1858. And so it does actually last quite a long time. But again, it doesn't really go past, uh, well, largely Boston, really. Um, you get another kind of system called the safety fund. You get that in New York State, which meant that in New York, what they did is they required banks to hold a certain amount of reserves, and these reserves would stabilize the overall system. But again, doesn't end up being that useful. The other thing that we had was free banking laws. What these free banking laws did, and you get these the earliest part in New York, is that the banks, what they would do is they would hold bonds, U.S. government bonds, and then what they would do is issue out the currencies based on those bonds that they were holding. And what it did is it allowed banks to kind of expand the number of branches that they had. And what it did is it allowed um, banks to be established as long as they had sound credit. You could establish your own bank rather than having to get any kind of special privileges or any special knowledge of someone to be able to start a bank. Um, and that's what you're kind of seeing described here. That you start getting a banking system that's going to work along this independent treasury system. And in that independent treasury system, what you're seeing is uh, a bit more stability in the banking system. Even though you're not regulating them more, the fact that they have to hold these federal bonds is doing some of that stabilization. It becomes useful as well in this chapter to talk about the gold rush. We talked about it a little bit in terms of it influencing the production of goods and even the transportation system. But it also, because we had this bimetallic standard where we did have gold within the system, it's also going to affect the currency. It's going to stimulate a great deal of growth, but the problem with the gold rush was the rush part of it. What that meant is that the money supply dramatically increased, and as the money supply dramatically increased, we did see a great deal of inflation. And you can see this actually in the book. Let me go back to the chapter. And you see this here, that in the years of the gold rush here between 1848 and 1855, what you're seeing is that in terms of overall prices, you get prices that are increasing, 17% in 7 years, from 1849 to 1855. And that a great deal of that, look at that, 58% increase in farm prices. A lot of that's coming down to agriculture. And that's not good, essentially. Um, the money supply, um, what we're seeing here is that the money supply is going from 100 to what? 100 to 169. So that'd be a 69% increase in those 6 years. So it'd be a little bit under 10% a year of an increase in the money supply. That's going to do a great deal to cause inflation in this economy. That's a pretty bad graph. But these words are correct, so I'd focus your eyes on that. And we obviously know what the negative consequences are to inflation, is that it does cause this hoarding, and it does cause problems with income levels and wages. The other issue that kind of emerges here, especially with the gold rush, is that you do get all this great deal of speculation in land, but then also speculation in other kinds of infrastructure like railroads and other kinds of things. And all of this is fueled by the fact that you have so much money. And now, kind of the closing slides here, what ends up causing some of the biggest problems in the lead up to the Civil War would be and not surprisingly, we get a financial crisis. And that financial crisis starts in 1857. Not surprisingly, caused by a large number of banks failing, which then brings down the infrastructure that was funded by them. And the banking system couldn't handle that. The banking system collapsed with this crisis. It starts with a very large bank failing, known as the Ohio Life Insurance and Trust Company. And then it's basically spreads east, further east. And basically, you have railroad bonds failing, you have canal bonds failing, and you get a pretty deep recession that can't be managed by the economy. And what this does, interestingly enough, too, and you see this in the closing lines of chapter 12. So if you like a good history, I'd encourage you to read especially the last paragraph of chapter 12 on page 218. Is that the theory of the authors of the book, which I don't entirely disagree with, is that the crisis of 1857 was deep enough and severe enough to convince the South that they didn't need the North, that the North was causing them problems, and that that's what we see right here. And so the South thought they could do it without the North, and they were going to just use their cotton to basically build up the system. Okay. Okay, let me pause here again. 1 second. And so even though there's actually 32 slides in this presentation, this is the last slide for this chapter. The rest of the slides, again, as it was generated by AI, it looks like it took from beyond the chapter of what you'd be responsible for. So again, this would just be another example of why I'm smarter than AI. Okay, so I think what this slide does, though, in a pretty succinct way, is it highlights for you, as I did even on the previous slide, it highlights the way in which the Civil War can be seen not only as a justice issue, a rights issue, a slavery issue, which would be the kind of classic line we learn about in high school and whatnot. but that it can really also be seen as this kind of end point where the South had been developing on one track and the North and the frontier were developing on a second track. And the financial crisis, the Panic of 1857, had highlighted just how you couldn't keep this bifurcation. You couldn't keep the South and North operating on different tracks. We needed a unified economic system, a unified monetary system, and we needed a unified uh, way that we are treating people, a unified sense of justice. And the Civil War is obviously sold as the unified form of justice, right? That all people, black and white, are created equal and treated equally and have equal rights. But that it's also, as we're going to see, starting with the next chapter that we deal with, chapter 14, is that it's going to give us the way to start to build a unified economic system in the United States. Okay, that ends our chapter here. So again, the rest of the slides, you can look at the rest of the slides, but we will be talking about the material on the rest of the slides in the later chapters.